There is one rule in trading that decides whether you survive long enough to learn anything at all. Not entries, not indicators, not predictions, size. The moment you choose position size, you choose your emotional state. You choose whether you will think clearly or panic. You choose whether a loss will be information or trauma. You choose whether discipline will remain intact or collapse under pressure. Most traders treat position sizing like a detail. It is not a detail. It is the foundation. Everything else sits on top of it. Before the market ever tests your strategy, it tests your size. Not because size affects price, but because size affects you. The moment you choose how big to trade, you decide whether you will think clearly or emotionally. That decision happens before profit, before loss, before outcome. Most traders get this backward. They choose size based on how much they want to make. That desire contaminates judgment immediately. It turns trading into a performance issue instead of a risk exercise. When profit becomes the reference point, emotional stability disappears. Position size is not a growth tool. It is a control tool. When size is too large, the mind enters defense mode. Every fluctuation feels threatening. Every pullback feels personal. Time compresses. The trader stops seeing structure and starts feeling pressure. This is not a discipline failure. It is a biological response to perceived danger. The market didn't create that pressure. The size did. A correctly sized position allows distance. Distance creates objectivity. Objectivity allows patience. With proper size, a trader can observe without interference. They can let trades develop. They can accept losses without immediate reaction. This is where real control begins. Traders often believe they need to become mentally stronger to handle larger size. That belief is misguided. Strength in trading is not about tolerating stress. It is about avoiding unnecessary stress so decisions remain clean. Oversizing does not make you brave. It makes you reactive. When size is wrong, even good traders behave badly. Stops are moved, targets are cut, rules are bent. Not because the trader lacks knowledge, but because emotional load exceeds capacity. Emotional control is finite. Position sizing determines how much emotional weight each trade carries. If a single trade can ruin your day, your week, or your confidence, the size is wrong. That trade has too much power over you. Smart traders protect their emotional bandwidth. They choose size that keeps every trade insignificant in isolation. No single outcome defines them. This detachment is not indifference. It is professionalism. The goal is not to feel nothing. The goal is to feel nothing that alters behavior. Profit potential is irrelevant if emotional control is lost. A perfectly predicted move means nothing if fear forces you out early or greed keeps you in too long. Execution depends on clarity. Clarity depends on size. Many struggling traders blame themselves for being impatient or undisciplined. In reality, they are asking their mind to operate under stress it was never designed to handle. They are oversized relative to their experience. Reduced size and discipline often returns. This is the uncomfortable truth. If you cannot trade small with consistency, you have not earned the right to trade big. Scaling is not a reward for confidence. It is a consequence of control. The market does not care how much you want to win. It responds only to how well you manage risk. Position size is the first line of defense. Everything else depends on it. Losses are unavoidable. Psychological damage is not. The difference between the two is position size. Every trader experiences losing trades. That is the cost of participation. But not every trader experiences loss the same way. Some take it, record it, and move on. Others spiral, chase, and destroy weeks of progress in hours. The market did not decide which path they took. Their size did. A normal loss, when oversized, becomes something else entirely. It stops being information and starts feeling like a threat. The mind reacts defensively. Logic weakens. Emotion steps forward. That is how damage begins. Oversizing magnifies impact, not just on the account, but on identity. When too much is at stake, a loss feels like a personal failure. The trader is no longer evaluating a trade. They are defending their self-worth. This is when objectivity dies. The pain from oversized losses lingers. It changes how the next trade is taken. Hesitation creeps in, confidence erodes, or worse, aggression takes over. The trader tries to erase the loss instead of execute the next opportunity. This behavior compounds risk. Small losses can be absorbed and learned from. Large emotional losses distort perception. They leave scars. Those scars influence future decisions long after the numbers have stabilized. The market did not scar you. You allowed size to do it. Many traders misinterpret this pain as weakness. They think they need to toughen up. They push through. They continue trading large, believing experience will harden them. It rarely does. Repeated psychological trauma does not build resilience. It builds fear or recklessness. Both are destructive. Smart traders respect emotional capital. They understand that the mind needs recovery just like the account does. They size trades so that losses do not echo into future decisions. The goal is not to avoid loss. The goal is to keep loss from. Altering behavior. Oversizing also distorts memory. One large loss overshadows dozens of disciplined trades. The mind fixates on pain. That fixation creates impatience. The trader becomes obsessed with getting back to even. Even is not a strategy. Trading to repair emotional damage is how accounts are slowly dismantled. Each impulsive trade adds pressure. Each forced decision increases the likelihood of another loss. This is a cycle created entirely by size. Correct sizing breaks the cycle. Losses remain losses. They do not become narratives. They do not demand response. They are processed and released. This emotional neutrality is not coldness. It is professionalism. If a loss keeps you awake, your size is wrong. If a loss changes your next decision, your size is wrong. If a loss makes you trade when you shouldn't, your size is wrong. The market offers endless opportunity. There is no need to extract meaning from every trade. Oversizing forces meaning onto outcomes. Proper sizing removes it. Protecting your mind is part of risk management. Those who ignore this learn the lesson repeatedly at increasing cost. Loss is inevitable. Psychological damage is optional. Discipline is not a personality trait. It is a condition. It exists only when the environment allows it to exist. In trading, that environment is defined by risk. When risk exceeds what your mind can tolerate, discipline does not weaken. It disappears. Rules stop being rules. They become suggestions, and suggestions are easily ignored under pressure. Most traders misunderstand this. They believe discipline is about willpower, about forcing themselves to behave correctly. They think if they just try harder, they will follow their plan. Willpower fails under threat. The human mind is wired to protect itself. When a trade carries too much risk, the mind shifts into survival mode. Logic is overrid. Then, the goal becomes immediate relief, not long-term consistency. That is why stops are moved. That is why losses are avoided instead of accepted. That is why profits are taken too early. These are not technical errors. They are stress responses. The market did not cause them. Risk did. Mental tolerance varies by experience, temperament, and recent performance. A size that feels manageable one month can feel overwhelming the next. Ignoring this reality is how discipline breaks down. Smart traders constantly assess not just the market, but themselves. They understand that discipline must be protected, and the primary way it is protected is through sizing. Discipline thrives in calm conditions. It dies in chaos. Oversized positions create chaos inside the trader, even when the market itself is orderly. When discipline collapses, traders blame the market. They blame volatility. They blame bad luck. Rarely do they blame the only variable they fully control: risk. Risk is not just a number. It is an experience. It is how exposed you feel. It is how much uncertainty your mind is being asked to hold. Ask it to hold too much and it will rebel. This rebellion is subtle at first: slight impatience, minor rule bending, justified deviations. Over time, these become habits. Habits become identity. At that point, discipline is no longer something you practice. It is something you remember having. Reducing size often restores discipline almost immediately. Traders are shocked by this. They assume their problem is psychological weakness. In reality, they were overloaded. Discipline does not require heroics. It requires appropriate conditions. When size is correct, discipline feels natural. You do not fight yourself. You do not debate every decision. You simply execute. This is how professionals operate. Not by being emotionally numb, but by structuring risk so emote. On stays within manageable bounds. If you constantly struggle to follow your rules, the solution is not more rules. It is less risk. Discipline is fragile. It must be protected deliberately. Those who treat it casually lose it quickly. The market is not testing your discipline. Your risk is. Patience is not something you summon. It is something you allow, and whether patience is available to you depends almost entirely on position size. Most traders believe they lack patience because they are restless or impulsive by nature. That belief misses the real cause. Impatience is usually the result of being overexposed. When too much is at stake, waiting becomes painful. The mind demands resolution. Large positions turn time into pressure. Every minute feels heavy. Every pause feels dangerous. The trader is not waiting for opportunity. They are waiting for relief. That is not patience. That is endurance. Endurance breaks. Correct sizing removes urgency. When risk is appropriate, time slows down. The trader can observe without discomfort. Waiting no longer feels like inaction. It feels like part of the process. This neutrality is essential. Markets spend most of their time doing nothing useful. They move, but they do not offer opportunity. Traders who cannot wait feel compelled to act anyway. They manufacture trades to escape boredom or anxiety. That behavior is punished consistently. Correct size makes inactivity acceptable. You are not pressured to trade. You are not emotionally invested in every fluctuation. You can let setups form instead of forcing them. Waiting becomes a decision, not a struggle. This is where real patience lives. Patience is not passive. It is disciplined restraint. It is choosing not to engage until conditions align. That choice requires emotional stability. Emotional stability requires manageable risk. Oversizing makes patience impose. Siebel. The trader feels they must do something. They feel responsible for constant action. They confuse activity with productivity. The market does not reward activity. It rewards timing. Smart traders understand that the hardest trades are often the ones you do not take. Skipping bad setups preserves capital, preserves clarity, preserves confidence, but skipping requires comfort with doing nothing. That comfort is created by size. When size is right, missing a trade does not hurt. Chasing is unnecessary. There is always another opportunity. The trader trusts the process because no single trade matters. This trust collapses when size is excessive. Every missed move feels like lost income. The trader feels behind. That feeling drives impulsive entries. The market punishes impatience without emotion. Correct sizing also allows patience in open trades. You do not exit at the first sign of discomfort. You allow the trade room to work. You respect the plan instead of reacting to noise. Noise is unbearable when risk is too high. Patience is not a moral virtue in trading. It is a structural outcome. It appears when conditions support it. If waiting feels impossible, do not blame yourself. Adjust your size. The market is not demanding speed. Your risk is. When size is correct, patience stops being a challenge. It becomes the default state. Most traders approach the market with the wrong objective. They want growth first, performance first, results now. Survival feels secondary, almost implied. It is not. Survival is the objective. Everything else is conditional. Without survival, there is no learning. Without clarity, there is no consistency. And without consistency, growth is accidental at best and destructive at worst. The market does not reward ambition. It rewards those who remain intact long enough to adapt. Clarity is fragile. It disappears quickly on D. Stress, oversized risk, clouds judgment. It narrows focus. The trader stops thinking in probabilities and starts thinking in outcomes. That shift is deadly. When clarity is lost, execution degrades. Trades are taken for the wrong reasons. Stops are adjusted emotionally. The plan becomes flexible at exactly the wrong moments. Performance becomes random. Smart traders protect clarity the same way they protect capital. They understand that mental capital is finite. It must be preserved deliberately. This is why survival comes first. Survival means avoiding decisions that can permanently damage the account or the mind. It means refusing to trade when emotional balance is compromised. It means respecting drawdowns instead of fighting them. Growth without clarity is unsustainable. Performance without discipline is temporary. Many traders experience short bursts of success, followed by sharp declines. They confuse this volatility with progress. In reality, they are oscillating between confidence and damage. This cycle continues until something breaks. Survival breaks the cycle. When size is appropriate, losses are manageable. Drawdowns do not distort perception. The trader remains functional. They can evaluate honestly. They can make adjustments without desperation. This is the environment where real growth occurs. Growth is not linear. It is uneven. It requires periods of stagnation. It requires waiting. Traders who cannot tolerate slow progress often accelerate themselves into failure. Survival allows patience with development. Performance is a byproduct of discipline, not the cause of it. Discipline requires clarity. Clarity requires manageable risk. This sequence cannot be reversed. Those who try to force performance ignore this order and pay for it. The market does not care how talented you are. It does not care how hard you work. It responds only to behavior over time. Survival gives you time. Time to refine execution. Time to understand yourself. Time to let experience accumulate. Most traders run out of time because they trade too big too soon. They treat the market like a sprint. It is an endurance event. Those who finish are rarely the fastest. They are the most controlled. If you are focused on growing the account, step back. Ask whether your current behavior supports survival. Ask whether your risk allows clarity. If the answer is no, growth is irrelevant. You cannot scale instability. The market is not going anywhere. Your opportunity remains as long as you do. Survival is not conservative. It is intelligent restraint, and restraint is what keeps you in the game long enough to matter. Rationality is not guaranteed in trading. It is conditional. It exists only when pressure stays within limits your mind can manage. The fastest way to lose rational thinking is to trade too large. Pressure does not announce itself. It builds quietly. Heart rate increases, focus narrows, time distorts. The trader feels compelled to act. At that point, logic has already stepped aside. Oversized positions create this state automatically. When too much is on the line, the brain stops evaluating probabilities and starts searching for certainty. It wants relief. It wants the trade to be over. This need drives impulsive decisions that feel justified in the moment. They rarely are. Trading small enough preserves space between stimulus and response. Price moves, but you are not forced to react. You can observe, you can think, you can choose. This space is where rationality lives. Small size does not eliminate emotion. It keeps emotion from controlling behavior. Fear may appear, but it does not dictate action. Hope may surface, but it does not override rules. That is the difference. Many traders resist trading small bec. As it feels insignificant. They believe progress requires discomfort. In reality, progress requires stability. Skill develops under calm conditions, not crisis. Crisis teaches survival tactics, not consistency. Rational trading depends on the ability to say no. No to marginal setups. No to revenge trades. No to emotional impulses. Saying no requires mental bandwidth. Oversizing consumes that bandwidth. Smart traders are not emotionless. They are well calibrated. They choose size that keeps stress in a range where thinking remains clear. They understand that the goal is not to suppress emotion but to prevent it from dominating. When size is correct, losing does not feel catastrophic. Winning does not feel euphoric. Both are processed as part of a system. This emotional neutrality is not detachment from results. It is detachment from impulse. Impulse is expensive. Trading small enough also builds trust.